So welcome again to UL System Financial Wellness Series, Money Matters for the summer of 2023. I'm Brian Bolton, finance professor at UL Lafayette. I'm also the content expert for the UL System, content expert on financial literacy. And today's session, number 9 out of our 15 session series, is on building savings account and emergency funds. This is probably one of my favorites to do in a setting like this. I like all the topics. This is maybe one of my favorites to do in a setting like this, because the topic is relatively generic and it's not as personal as maybe many of the others. And I can actually give advice, and specific advice that's generic or general to lots of people. So hopefully that'll come across. Again, I'm Brian Bolton. Brian.bolton@louisiana.edu is my email. Feel free to reach out to me with personal questions, with the foundations, technical, investing, budgeting, anything related to financial literacy, and certainly anything related to building savings accounts and emergency funds, today's topic. This is my personal advent calendar. We've got a series of 15. We are on number 9, counting down. We'll be done on August 2nd. And kind of getting back into some family planning in a couple of weeks, getting back into entrepreneurship, and then concluding with kind of a generic conversation about inflation and turbulent economic times. As I mentioned yesterday, we've had some relatively good news about inflation. We were 9.1% a year ago. We're down to 3% today, which on paper sounds great. If you go to the gas station, it's pretty good. If you go to the grocery store, it doesn't feel that good. And buying other things maybe doesn't feel that good. So, and 3% inflation is still higher than most of us are used to. So we'll see what the economy looks like in 3 weeks when we get to August 2nd and conclude. But it'd be a fun way to end. But today we're talking about savings accounts and emergency funds. And as I said, the introduction, I like this topic because it's relatively generic, and I can kind of give some guidelines, some advice, some games, tricks, hacks that apply to most people that are less sensitive to your personal situation. This is what we're always trying to get to. We're trying to get to happiness, fulfillment, satisfaction, something, combine short-term goals and long-term goals. We'll talk about kind of both of those as we get to savings, and we'll kind of focus on that short to medium term perspective. So we'll kind of ignore the long term today and focus on short and medium term goals from a savings perspective. All this fits into this broader model of family needs, financial needs, professional needs, career needs, educational needs, health needs, trying to get that balance, trying to figure out happiness, and my job trying to figure out how financial wellness fits into all this. As I said, personal finance is personal. You have to make it about you. It's not about anyone else. There's no ego. Flexing feels good, but it can be pretty damaging to your financial wellness and financial situation. So make it about yourself. Make it very personal. Again, it's personal. It's hard for me to give specific advice, but today I can. And there's probably one piece of advice, one word of advice that I can give to most people, and we can all use it to improve our financial situation. And that word is save. Wherever we can save, that gives us options, that gives us flexibility, and that improves our financial wellness. I think most of us are trying to get to some level of wealth, whatever that means to us, whether it's wealth in time, wealth in relationships, wealth in money, what different level of comfort or wealth is important to you. We all going to have different perspectives, but it starts with savings. We start with savings, we get into investing, whether that's in a home or stock market. Talk about that in a couple of weeks. To this sense of ownership. Again, that could be a home, it could be a car, it could be a business. And somehow that leads to wealth. When I say somehow, it leads to wealth if we have a plan and we're successful with our decisions. But somehow we define wealth in different ways. Everyone here may define wealth in different ways. There's no right or wrong way, but it all starts with savings. So that's the focus today. Many of you have seen this model before. We all have dreams, values, and goals. That's where we want to get to. That's what we're trying to achieve. To get there, we start today with our current situation on education, career, family, financial, health, everything else that about today. And then we create a personal financial plan to help achieve those values, dreams, and goals. Today's topic: savings, building savings accounts, building emergency funds. And when we create this personal financial plan, everything is about savings. Everything starts with savings. That creates opportunities for investment. It creates opportunities to manage debt. It helps us manage taxes and budgeting better. And then getting to the second and third tiers of insurance, retirement, education, family, business issues. Everything starts with savings. The better we can do, the more control we'll have on our financial plan and financial situation in the future. I've introduced this model with 7 goals that, whether you're in grad school, whether you're undergrad, or whether you're professional, working full-time, these are 7 goals that most of us can work towards, and that probably can make a really big difference in our financial wellness, in our financial state of mind, if not just our bank account. Should do both, right? The 5 that are highlighted in yellow are really about today and savings. So we'll start talking about tracking every penny you spend. It says every semester, but do it every month or every few months. Talk about discretionary spending, talking about savings accounts. We won't talk about the IRA today, but the IRA is a long-term savings mechanism. We'll talk about it a little bit, but not in detail. That's a longer term. And then, as the title of the session shows or suggests, we will talk in the next couple of slides about an emergency fund. What is it? What do we do with it? Why do we care? So with these goals, these 7 goals that I've used in different settings, most of them about savings. Most of them start with savings, and that's why it's important. If you pay $1,000 to go talk to a professional financial planner, they are probably going to introduce something like this, with 3 financial planning priorities, or 3 panels of financial planning. Priority 1 is about insurance and risk management, and making sure you've got that covered. Your assets, your income, your health, making sure you've got the most important things in your life protected from a financial perspective. Panel 3, or priority 3, is long-term savings investment. Thinking about retirement, thinking about education for Jack, Jill, Jane, kids, whomever else. Any large purchase goals, we'll talk about those in a couple of weeks. Any legacy goals, whether that's a business or philanthropy. Today we're talking about the panel in the middle, the priority in the middle, looking at the adequacy of our emergency fund, of our spending, our discretionary and non-discretionary spending. That is, this panel, this middle priority, is probably the most tangible to most of us, because when we budget or we go to the bank or we look at our ATM account balance, we feel it, right? Insurance can be something esoteric that you only feel or touch when you have a claim or an issue. Long-term savings and investment, term, right? I'm not going to retire for 20 years or 40 years if you're in grad school, right? And so it doesn't feel tangible, whereas the short-term savings, investment, debt management, that is tangible. That's a part of your day-to-day life. And that may be what causes you the most anxiety, is being able to meet those short-term obligations, or being able to build some savings to give yourself a little comfort and create some options. It's not necessarily the case that if you struggle in the middle panel, you're going to struggle with priority 3, but math is additive or summative. If you have 0 saved for the short term, but 1,000 saved for the long term, maybe there's a better way to manage that. Maybe you want 500 and 500. And so math doesn't lie, and it is additive. And so thinking about how to allocate or diversify your priorities across these 3 panels is a big part of financial planning. And I say to allocate the priorities. The risk management, the insurance one, it's a little different. We still have to pay for insurance, so we need the money to pay for it, but it's less about savings and investing directly. It's about protecting those assets that are most important to us. So let's start with your goals. Spend an afternoon going through your budget. Maybe it's not an afternoon, maybe it's a weekend, maybe it's 2 or 3 nights. Pick a month. I do this every month. I do it rigorously twice a year, and identify every penny that you spend. during that month. Track and know everything. And when you do this, I'm a big fan of doing it old school. Don't rely on apps, don't rely on websites, don't rely on your credit card or your bank statement. They have great tools that can help us form what we're doing. But those tools become black boxes and we don't really know what's going on. And I'm not a masochist, but I want tracking my income and expenses not to be painful, but I want it to be tangible. I want to know what's going on. If I'm spending $100 a week on coffee, I want to know that. If I'm spending 20% of my budget after 10 p.m. every month, I want to know that. And the best way to know that and figure that out is by getting your hands dirty and digging into the budget and the expenses. For most of us, it'll take 1 to 2 hours. Right? If you have a large family and more complex expense situations and budgets, it may take a weekend the first time, but each subsequent time it should take less and less. As you identify all your expenses, categorize each as either non-discretionary, that means essential. These are not choices, these are part of my life, my livelihood, and then discretionary. You can think of these as needs versus wants, essential versus not essential. You can use whatever term you want. Different people like different terms. A lot of people don't like to think of going to a restaurant as not essential, whereas a financial planner might think of it as discretionary. And then kind of once you get this figured out, I'm a huge fan of paying yourself first, adding an expense line for savings. Savings is not what happens after everything else. Make savings happen immediately or first. And we'll talk about a couple of different ways to do this, or several different ways. A lot of people, when I say this, they feel pressure, like they're worried they're not savings or they don't have the savings. Well, you may have more savings than you think. And one way you may have savings is through retirement plans. And so if, in addition to that, if you can move some money, however much, whether it's $5 a month or $500 a month from your operating account, your checking account, whatever it is, to one or more savings accounts on the first day of the month. Don't wait until the 20th or 25th or 30th. Move that amount on the first day of the month. When I was just beginning my professional career, I'd move $100 first day of the month. And many times by the 15th or 20th, I'd have to move it back to operating to buy food or pay rent. But I got in the habit of moving it on that first day just to create that habit, to remind myself consistently this is the priority. And over time, my budget provided more flexibility. That habit was still there. And so that $100 that I put into savings and moved from checking to savings, eventually it stayed there. Early on, it didn't stay there. Early on, I had to have it. I had to move it back to checking account to buy food. But it's about the habit. And so if you can get in the habit of just moving something, whether it's $5 or $10, that's a great habit that over time will give you agency and create opportunities. So this is a basic budget template. The numbers I've designed for grad student or undergrad, but it could be for anyone. And the top line is savings. Top line is savings, putting $25 from whatever source, whether you're waiting tables or bartending, or you've got a graduate assistantship, or obviously if you're a professional with a full-time job. UL Lafayette, I get paid on the last day of the month. On the first day of the month, I move money from checking to savings. And that goes out before I pay rent. It goes out before I pay my phone bill, insurance, before I buy food. It always goes directly from checking to savings on the first day of the month, the day after I get paid, or whatever the timing looks like. And then just go through, and I've got subscription 1, 2, and 3. Be more specific. Whether it's Amazon Prime or Netflix or whatever the subscriptions are. And with the entertainment, the more you can break that down and kind of these other things, clothing, shoes. If you have 5 children, do clothing for child 1, clothing for child 2, clothing for child 3. And again, I'm not a masochist, but we want to feel this. We want to connect with this and really know what we're doing. It's not just about math, it's about behaviors. And by putting together this spreadsheet or some template and really getting up close and personal with this, you feel it, and you can internalize what your behaviors are. And if you see that Amazon Prime $179 or whatever it is now well, once a year, and you kind of think back, am I getting my money's worth out of that? Could I live without that? Maybe you can. But if you just see the sum that you spend $1,189 this month, you may not feel that behavior. You may not feel empowered to change things and improve things. So create yours. I've got budget templates. This is from a spreadsheet that's on my website. I can send this to you. You can play around. We can customize it however you want. But again, I'm a big fan of doing this up close and personal. Don't rely on your bank. Don't rely on your credit card company. They're going to give you these. They're going to give you pie charts and show you how much, what percentage of your spending is at restaurants and how much is it on gas stations. That's great. That's a start. But then you need to go kind of the extra step and really get personal. And so the next step is to go through each of these accounts and identify them as non-discretionary. Non-discretionary is essential. And if you're a student, rent, housing, school tuition, school supplies, those are all essential. Phone and insurance, those are all essential. I've labeled savings as essential. I've labeled savings as non-discretionary. Let's at least start with it being, non-discretionary. Let's get in that habit and, get used to doing it so that over time it absolutely becomes essential and non-discretionary. I've also got food as non-discretionary. Food at the grocery store. A lot of people have different conversations and perspectives about kind of the non-discretionary nature of food. Some people would have restaurants as non-discretionary too. Okay, maybe so, right? If you're driving in your car 10 hours a day, making deliveries or whatever, and you don't have the capability to bring a sandwich to work, you have to go out to eat, right? And so each of us is going to have different flexibility with our food, choices. But that's the point of looking at this up close and personal. Really figure out what you're spending and where you're spending. When I work with people individually, most people are shocked how much money they spend dining out, whether that's at sit-down restaurants or fast food, or even coffee and drive-through breakfast or whatever. If you sit down, you do the math. As far as I'm concerned, I spend maybe not a lot, but I spend probably more than I need to on coffee. And every time I sit down and do this, I eventually begin a habit of spending less on coffee. And is coffee essential? Kind of. But maybe I could get just a $2 drip coffee instead of a $5 latte. And so as I sit down and I do this and I feel it, it helps me make decisions. So those are non-discretionary. The rest is discretionary. Again, some of the subscriptions, if you're a parent having subscriptions for your children, that may not be discretionary, that may be essential. Different entertainment you may feel is essential. And so that as you go through this, I've got 2 levels, discretionary, non-discretionary, yes, no. You could have 3 or 4 levels, kind of absolutely positively essential, rent, housing, mobile phone, car insurance, health insurance. Then there may be kind of a level 2 that's kind of necessary, but I could have some flexibility. Maybe that's your food and your groceries. Maybe that's your subscriptions. Maybe that's your entertainment, clothing. And then there's kind of level 3 that's, maybe gym, yoga, fitness, charity, and so forth. So I've got 2 levels. Feel free to create more if that gives you better customization. We put these 2 together. We've got all of our expenses accounted for. We can kind of look at this and, well, the spreadsheet's objective, we can then take a look and say, does that feel right? And maybe you have 3 or 4 categories for food: essential food, optional food, essential restaurants, optional restaurants, or something like that. Create what works for you. As we go through this and you identify your discretionary spending, can you decrease your discretionary spending by 25% over the next 3 months, 6 months? Can you go through your discretionary spending budget and identify ways, whether it's subscriptions, impulse purchases, coffee, fast food, entertainment, whatever? We're not trying to eliminate everything. We want to at least just be intentional. We go through the budgeting to be intentional and to make sure we see and feel the decisions that we're making. If you can decrease your discretionary spending by 25% over time, that's great. And if you can continue decreasing, right, you may find that you need or want to decrease it by 50%. do it, right? And start with this process, decrease your spending, and that will give you so much flexibility. And today we're talking about savings. The less we spend, the more we can save. When we look at our non-discretionary, can you decrease this by 10%? Can you change your insurance? I check insurance prices at least once a year, usually twice a year. I change my insurance carriers maybe every 3 or 4 years when the savings is big enough. Can you change your phone carrier? Can you buy groceries in bulk, spending whatever it is now, $60, $70 on a Costco or Sam's Club membership? One tip that I got from a student with 3 or 4 teenage boys, every January, their family doesn't go to the grocery store. They don't go to the grocery store in January. They've been building up food the previous year and certainly through the holidays, and they empty their freezer in the pantry. Whatever's in there, that's what they're eating. They'll go to the grocery store maybe for perishables, for milk and fruit and vegetables, but nothing else. And with a family with 3 or 4 teenage boys, she saves hundreds of dollars. Kind of savings. I mean, she already spent the money. The family already spent the money, but in this country, we throw away so much food that if you can get into the habit of emptying that freezer and pantry so you never throw away food that you already bought, or you throw away as little as possible, maybe that's your 10% savings in non-discretionary. Look at your subscriptions, look at clothing, whatever else you may have categories as non-discretionary, and think about, can I get that 10% down? Then once you have that, these red numbers, these are your discretionary expenses. What happens if your air conditioning dies? Past month, I've been worried about that every day. That my temperature's at 95 and heat index at 110. What happens if my air conditioning stops working? What happens if my car stops working? Right? And what happens, the worst case scenario for many of us would be losing our job. The emergency fund is there to protect us from all of those. And ideally, your emergency fund would be a savings account, not a checking account, but a savings account that you don't touch for any other reasons, with 3 to 6 months of non-discretionary expenses saved up. So in this example, our discretionary expenses are $1,050. The minimum we'd want to have $3,000, $3,150 just in that emergency fund. Do not touch until there's an emergency, right? When you have an emergency, you touch it, you use it, and then you build it back up. At the higher end, we want to have $6,300 or 6 months of coverage. Use some flexibility, use some discretion with this non-discretionary emergency fund. If you have a lot of job security and maybe no children, then maybe you can get away with 2 months. If you're an entrepreneur with 5 children, you may want to have $10,000 saved up in this example. Right? An entrepreneur, your income stream may be less predictable. You have 4 or 5 children. There's a lot more unpredictability there about expenses and emergencies. And so your situation, we say 3 to 6 months to allow some flexibility for your situation. But if you've got job security and limited uncertainty in your budget, you could get away with 2 to 3 months. If you have a lot less certainty about income and expenses, then you want more comfort. You want kind of 6 to 8 months. How do you do that? There's no magic approach. You build the habits. You save $25 on the first day of the month. You reduce your discretionary spending by 25%. You reduce your non-discretionary by 10%. Whatever ways you can go about decreasing your spending, that's going to give you this flexibility. In yesterday's session, we talked about changing careers. For most of us, if we want to substantially increase our income, we change jobs or we change careers. But today we're talking about budgeting, and today we're talking about savings, and that starts with expenses. So if you can get a shot, you can get a 20% increase in your income, great. That gives you a lot more freedom with your expenses and your budget. But as long as your income is relatively stable, maybe increasing at 2 to 5% or cost of living adjustments or whatever, then the savings will come from managing your expenses. And this is where we start. So a frequently asked question that I get asked is, how much of my income should I be spending on various things? Paying off various loans or other budgets? There's 2 ways to answer this, from a lender's perspective and from your own personal perspective. Historically, if you go to a lender, they're going to tell you that 28% of your gross income should go to housing payments at most, 28% or less. And this includes rent or mortgage, taxes, insurance. It does not include maintenance or utilities. So it's the fixed obligations to your home should not make up more than 28% of your gross income. When we add in other debts, the lender is going to look at do the math and see if 36% of your gross income, again, gross, that's your kind of stated before taxes, before deductions, anything else, income, should go to all debt payments, including housing, credit cards, student loans, auto loans, whatever else. I mentioned this and I focus on debt because debt for many of us, while it didn't show up in the previous budgets, it probably should. And for many of us, debt payments and obligations are a big part of our budgeting process. At different times in your life, you're going to be maybe a little bit over this, the 28 and the 36%. If you go in and 50% of your income is obligated or directed towards debt payments and you go in for a new loan, that lender may charge you a slightly higher rate or maybe a significantly higher rate. If you go in to buy a house, get a mortgage, and your debt obligations or your housing payments would be 40% of your gross income, one, you may not get that mortgage, or two, you may have a significantly higher rate. So if you can manage your housing and your debt expenses, that gives you flexibility and more options on kind of future loans and future debt, future borrowing. These ratios are kind of based on payments, not borrowed amounts or loan balances. One trick that lenders love to offer is to reduce your payment by extending your term. You borrow $10,000, and if you pay that back over 5 years, it's going to be a certain amount. But if you pay it back over 10 years, it's going to be a lower payment, right? So if you extend the time by several years the time to repay by several years, your monthly payment, your annual payment is going to be lower. But that actually increases the total cost of the loan because you pay a lot more interest. So be very careful when you're getting out loans and you're looking at these ratios. Sometimes in our lives, we have to extend because we just don't have the cash flow. We just don't have the income. But if you can go back to discretionary and non-discretionary spending, maybe you can free up some income, thereby decreasing the term on your borrowing. And so that's the point. Be very careful. Lenders love it when we extend our loan term. When we go from 5 years to 7 years or 10 years, because they make more money. Maybe a good deal for us, again, if we don't have the income to meet the payment on a 5-year loan, but just do that knowing you're going to be paying more in interest and total expenses. So 28, 36%, beyond that, and you get into food, insurance and other expenses, it's going to differ by everyone about every situation. But if we start with this living expenses, the home expenses at 28%, and then all debts at 36% or less, those are good rules of thumb to think about as we're building our budgets. That's the lender's perspective. From the personal perspective, it really depends on your other goals, investments, and your specific situation. Like I said, if you buy a home, your debt's going to increase. It might go from 28 to 40% initially. Over time, it should decrease as you're paying off the debt or as your income increases. If you have children, you may be increasing your debt as you save their education or incur other expenses, maybe healthcare or credit card debt or whatever it takes. It's okay, right? In recognizing that this is not necessarily temporary, but it's specific to this situation and it will change over time. You can offset some of these expenses, the housing costs, by having a lower balance on your auto loan or reducing your student loans. A lot of financial planners say the best place to save money is with your car. That flexing or spending too much money on a car is an absolute waste of money. Susie Orman, Dave Ramsey, they'll tell you don't buy new cars too. Well, sometimes that works for us, sometimes it doesn't. But just recognize that if you buy a fancy new car, it's going to be a double whammy on your auto loan. We have lots of options. We have more options than we think. And especially when it comes to credit card balances, pay the balance off as soon as you're able, because that interest expense will compound, and 25% on 25% on 25% will get extremely expensive, and that will make everything else that we're talking about through this series and in today's session virtually impossible. It's hard to save when you're paying 25% interest on a credit card balance. So personal perspective is going to depend on your situation. But then kind of once we get beyond that, and we talked about emergency accounts, emergency funds 10 minutes ago. How do we do that? A big goal for me, and one I want you to think about, is set up separate savings accounts for each savings goal, and then add money to each. What does this mean? You've got a checking account, you've got a savings account, you might have a retirement account, you might have 3 savings accounts. But think about your life, think about what your goals are. What are you saving for? If you have 3 children, set up a savings account for each of the 3. Not in their name, but keep it in your name for their clothes, for bike, for holidays, for birthdays, and then add to each. Our minds are wacky. Our minds are weird, and we engage in behavior that we call mental budgeting. If I have $10,000 in one savings account, it feels very different than having $2,000 in each of 5 different accounts. And that's mental budgeting. Our minds are dumb or weird. Minds are brilliant, but they're wacky, not dumb. And I have $10,000 in either case, but it just budget-wise, mentally, it's different whether that 10,000 is in one account or 5. And if each account has a different purpose, there's a little regulator, a little governor in our head, in our brain, that makes sure we're only using that money for a specific purpose. We're not good. We're cautious about moving money between accounts. If I've got $2,000 in a college account for my son, I'm reluctant to move that $2,000 into my vacation account. And from a financial planning perspective, that can be pretty healthy, right? And so that little governor makes it uncomfortable. He's wagging his finger, a little devil on our shoulder, or whatever the analogy is. Don't do that. And so if you have these separate accounts set up, that mental budgeting takes care of itself. Some banks will let you do this automatically, just by pushing a few buttons. A lot of, in the US, most banks do not. Internationally, in other countries, it can be a few clicks of a mouse or a phone call to get 3 new savings accounts set up, kind of all within one umbrella account. In the US, you kind of have to go through the process of setting up a new account for each goal. They can be linked, but it will take 10, 15 minutes maybe to set up each one. Not a ton of time, and probably worth it. So if you can't do it automatically with your bank, do it yourself. Set up 3 to 5 different savings accounts for different goals. Go through my example. Last day of the month, I get paid, and my paycheck goes into one bucket. Separately, and at the same time, the university, ULL, gives me some contribution for my work retirement plan. That's a separate bucket. That's a restricted bucket. Money goes there. I don't touch it. Paycheck money, yeah, I touch that. I pay my bills, pay my non-discretionary and discretionary. But then I also try, I don't always succeed, I try to move some of that money into a short-term, medium-term goal fund. So this could be a vacation, maybe it's a new car, maybe it's a new refrigerator, but I have a specific savings account set up for that short and medium term. Maybe I have 2 or 3, but I have a specific account. I also have a long-term account. Maybe a lot of students and young professionals ask me, how do I save for a home? This is how you save for a home, right? If saving for a home is 5 to 10 years away for many people in their early 20s, you do it by being intentional. You set up an account. Sometimes I move money from my checking account. So that top bucket is basically my checking account, my operating account. Sometimes I can move directly from there to long-term. Sometimes I move from my short-term to my long-term when there's excess, or when my goals either change, or I take that vacation and I've got money left over, or whatever the case may be. But I'm not done. So I've got the short, medium term. I also have more retirement. I'm a big fan of everyone having an individual retirement account, IRA or Roth IRA. I'm fortunate, I've got some contribution to the work retirement plan, but I also want to have an individual retirement account on my own that I'm adding to. And when you look at this, it looks complex. You set this up, it's not complex. You can do all this within one financial institution. When I say savings accounts, multiple savings accounts, I don't necessarily mean multiple financial institutions. We can do this all at one financial institution, just 3, 4, 5 accounts at that institution. And once you get it set up, it's pretty easy to track. I also don't necessarily mean huge dollar amounts. If you're doing $5 in each, that's great. It's about building the habit and letting that grow and letting that accumulate. So this model, this example looks at time horizon, but maybe your mind doesn't work well like that. Maybe you want to move from this time horizon model to a specific goal. And you have savings accounts set up for a vacation. One for vacation, one for a new car, one for a new house. In your mind, these will be aligned kind of with short, medium, and long-term goals. But maybe it helps you think about specifically, okay, I've got $2,000 in my vacation fund, or I've got $7,000 in my new car fund. And great, right? Then when you go on that vacation, you spend the money for the vacation, you can repurpose that savings account into maybe next year's vacation or new refrigerator or whatever else the priority may be. However your mind works, one of these two formats would probably help. And by being intentional and setting up the accounts, it'll free up, it won't increase your income and it won't decrease your spending, but it allows you to be intentional and strategic about how you're saving and what you're doing with your savings. I do this, I think I'm up to 6 accounts on a regular basis. I've got, I think I'd probably say I've got 2 retirement and probably 3 in the short term and long term. I probably have 2 short, medium term savings accounts, 1 long-term savings account, 2 retirement accounts, and 1 checking account. And with these different purposes, I also have 3 credit cards, and I use each of the credit cards differently. I have 1 credit card that just pays bills. I have 1 credit card that pays for coffee and groceries and gasoline and regular operating expenses. And then I have 1 checking account that pays for credit card, that pays for non-recurring expenses, the new refrigerator, the vacation. And each of those credit cards is aligned with a different account. And so I've created this strategy, structure, and intentionality. Within each of these accounts, we can have different return options. We'll talk about investing in a week or 2. 2 weeks, I think. Maybe it's next week. And so within different accounts, you can have different investment options. With my checking and savings accounts, I don't want to invest. That's just cash. I don't care about getting a return. I'm going to keep as little as possible in there to get me to the next paycheck. I'll move everything else over my short and medium term goals. I haven't talked about an emergency fund on this slide, but that's probably one of my short and medium term goal buckets or accounts. And so your emergency fund is not necessarily checking or transaction. It could be, or maybe it's kind of short, medium term savings account where you're getting some return on investment, some interest rate, but there's no restrictions and you can take 500 out to get a new air conditioner or whatever the case may be. So checking and transaction, no return, no risk, all cash. But then maybe I take some risk with the others. Short, medium term, maybe it's a savings account, or maybe I'm able to lock it up for longer term and get a certificate of deposit. Some certificate deposits are starting at 1-2%. You can get a certificate of deposit for 6 months now at 5% interest, which is great. Put $1,000 in, you get 5% back over a year. That's $50, $53. It'll be taxed, but quasi-free. Or maybe I get a little more aggressive and I invest in a government municipal corporate bond that has a little more risk, but not a lot of risk. I want this money to be liquid. If this isn't my emergency fund, it's kind of like my emergency fund. I need to be comfortable taking money out of this and converting either these investments or this cash to enjoy my goals, to pay for the vacation, pay for the new radiator or air conditioner or whatever the case may be. Within that longer term, maybe I want to buy a house in 10 years and want to save $50,000, whatever. I really want the house, but I'm kind of flexible on the timing. I can 8 years, 7 years would be great, but 12 or 13 is okay. Or maybe I just my first child and I want to start a savings plan for them in 18 years. When I have longer term, I can take more risk. Liquidity is not a problem. If I put $500 in my child's savings account, I probably shouldn't touch it until they go to college. If I have a health issue or there's a big emergency, yeah, I can touch it, I can use it. But I don't care about liquidity in general. I don't care about getting that money. I can take more risk, lead to higher returns over the longer term. Maybe I choose index funds, maybe I choose mutual funds. These are investing terms, investing funds. We'll talk about those in our investing 101 session. The stock market is up about 15% this year through 7 months, 6.5 months. It was down 20% last year. So there's significant risk. But over the past 100 years, the average has been positive 10 or 12% return. Patience is the key. If you're going to invest in the long term, expect some volatility, expect some uncertainty, expect an occasional year like 2022 when my retirement, my long-term investments lost 20%, but I'm making up for it this year. And I'm getting it back this year. And over time, if I can average 10% on these goals or even less, 3 to 7% for some of these goals, that's kind of free money and it's kind of good. The last is the retirement. If you've got a company sponsored account, so 403B or 401k defined contribution plan, those are great. It does limit your options, but it's kind of free money or free option, free flexibility. You've got tax benefits. You may get a match from your employer. These are tax preferred. So because we get the tax benefits, there are some strings attached, and the IRS doesn't want me using this money for my new house or my kids' college. And it's going to charge me taxes and a 10% penalty if I take it out for an unapproved use. Different accounts, different types of accounts, you can borrow from it, or you can pay for health or first-time home buyer or some other special situations out of a retirement account. But in general, when I put money into my retirement account, I don't expect to touch it until I'm 60 years old. 60 years, 59 and a half is when I can take it out legally. But that's, but I know it's there if I absolutely need it. Liquidity is not an issue. I care about growth. I care about that interest rate, that average 10 to 12% over the long term. I also kind of like the idea of minimizing taxes, not eliminating taxes, but through these retirement options, I'm able to reduce or minimize my taxes, both today and in the future. And I care about getting that maximum company match. My company, if I save 8% of my paycheck into a retirement account, my company is going to give me a free 6%. So I put in 8%, I end up with 14%. That's kind of free money, right? And that's pretty cool. You do that every year for 20 or 30 years, and you're getting a 10% capital appreciation. Pretty soon, that's some real money. And over the long term, if you've got this account set up and you've got the structure set up so that you're matching different accounts for different time periods or different goals, even if I don't add anything to my savings account from the left, I still have this retirement that's happening. And to me, that is savings. That retirement account, that contribution, that 14% of every paycheck that's going to my retirement account, that is savings. We don't call it savings, but it is. What are we saving for? We're saving for the new radiator, the new refrigerator, the new air conditioner. We're saving for our college education. And for me, certainly, I'm saving for retirement. Well, my university is helping me do that already. And so if I can't save too much on the left in the short term, I don't beat myself up because I still have some retirement savings going on. When I can save more in each of these accounts, that's just a win. And that gives me more comfort, more peace of mind, more financial wellness, kind of anything and everything. All this starts with savings. The more we can save, the more we can invest, the more we feel like owners. And over the long term, the more wealth we're going to build. Plans are going to change. Maybe you change your job, maybe your children change their situation. But we all start with setting goals, analyzing reality, we're analyzing our situation. We create that plan, we execute the plan, and then we adjust because life is going to throw some curveballs at us. But this all starts with habit. Today, we're talking about savings. Yes, there's some structure, there's some systems, some accounts that we can set up, but it all starts with habit and our behavior, getting used to making saving a priority, getting used to analyzing our expenses and being honest with ourselves and being calling ourselves out for bad behavior and changing our behavior. When I have bad budget behavior, there's only one person in the world that knows, and that's me. And I fix it. I don't beat myself up. I change it, right? And whether it's buying a couple extra lattes a week or impulse buying new shoes or whatever the case may be, when I see my habits, I'm able to change it. Wealth is largely the result of habit. And it all starts with our behavior and our habits. That's it for today. Hopefully there was something in here that you can use. We'll be back at this next week for financial planning for veterans. Try to capture a number of different issues and challenges that the veterans may see as they're trying to achieve financial wellness. And then we'll close next week with, you're thinking about retirement, it's getting close, but it's not imminent, you're not retiring, but as you're 5 to 7 years out, what are 5 to 10 things you need to be planning or preparing? If you're 20 years out, hopefully there's still something useful. If you're 2 years out, hopefully there's still something useful. And that 5 to 7 year window, we chose that because it's the most kind of visceral or tangible. And there are some things you can do. If you're 20 years out, there's a ton of things you can do, but you may not do them. If you're 5 years out, there's some things you can do and you probably will do them. Whereas if you're 1 or 2 years out, you may be limited in what you can do. Anyway, so then we'll get back to business, side hustle planning, financial planning for the fun stuff, which is similar today. We'll focus on 1 or 2 of the buckets that we talked about today and that June 26th. We'll go into investing on August 1st and conclude with navigating the effects of inflation in turbulent economic times. I'm Brian Bolton, Brian.Bolton, Louisiana. Please reach out and we can chat more about this or your situation. Talk about setting up those multiple accounts and different accounts for different purposes. Talk about analyzing your budget and getting to that, having money to save by being diligent with your budget, or we can talk about whatever you want to talk about. That's it. I'm going to stop sharing. I'm going to stop recording.